Today is March 17th, 2026. At this point in time, let's start with a quick summary and review of the storm of blood and gore the silver market has endured over the past 2 months, as well as the latest market quotes. Just this past January 2026, we witnessed history, accompanied by intense global geopolitical turmoil, such as the continuous escalation in the Middle East, stubborn inflation, and the frantic push of the global de-dollarization wave. The precious metals market saw an epic explosion. The big brother gold was unstoppable. It not only shattered all-time highs, but incredibly stood above the staggering $5,000 per ounce mark. As the little sister of gold, silver naturally refused to be outdone, staging a one-way parabolic rally in January that sent global retail investors into a total frenzy. On January 29th, the price of silver touched an all-time high of $121.67 per ounce. Yes, you heard that right, $121.67. During that time, the entire market fell into absolute madness. Every media outlet, forum, and retail group was screaming silver to 200, or silver will surpass gold. Countless retail investors who had zero understanding of silver's underlying logic were blinded by those massive weekly green candles and FOMO'd in at the top with full leverage, terrified of missing out on this get-rich-quick feast. However, the good times didn't last, and the feast instantly turned into a meat grinder. Just as retail investors were dreaming of making a fortune, Wall Street's scythe swung down mercilessly. Entering February, the Chicago Mercantile Exchange, CME, pulled its old tricks again, suddenly announcing a massive hike in margin requirements for silver futures. This rug pull directly triggered a stampede-style crash in silver. In just a few days, silver prices plummeted from the $121 clouds down into the abyss below $65. A haircut, a total 50% haircut. Countless retail traders who used leverage to chase the top were liquidated instantly, losing everything and ending up penniless. Fast forward to today, mid-March 2026. After that horrific washout in February, the current silver quotes have finally begun to stabilize. According to the latest market data, the international spot silver price is currently consolidating around 81.34 per ounce. Compared to a month ago, the price has recovered by nearly 5%. And compared to the same period last year, the gain is still a staggering 139%. Many retail investors who were trapped at the highs or washed out at the lows are feeling extremely lost now. They ask me in despair, is silver completely finished? Is the bull market over? If you think so, then congratulations. You have perfectly fallen into the trap Wall Street meticulously dug for you. Today, I want to tell everyone clearly, the current pullback in silver is absolutely not the end of the bull market. On the contrary, it is a massive conspiracy orchestrated by Wall Street to clear out the massive short positions in their hands. The current correction level is exactly the golden pit where we should discard the retail mindset and apply the smart money logic of buying low and selling high. To see through Wall Street's conspiracy, we must first understand why silver went up and why it is destined to go even higher in the future. The current logic behind silver's rise is not short-term speculative hype. It is based on a physical law that no institution can defy: tight supply and demand, with a deficit that has lasted for years. Let's look at the demand side first. Silver is not just a precious metal, it is an irreplaceable key industrial metal. In the wave of modern technology and the new energy revolution, silver plays an absolutely core role. First, the photovoltaic (PV) industry. Manufacturing solar panels requires a massive amount of silver paste. As countries worldwide push for carbon neutrality and clean energy, PV installations have seen exponential growth. Especially by 2026 today, the popularization of next-generation high-efficiency solar cells, such as TOPCon and HJT, requires an even higher silver loading per unit than before. The PV industry has become a giant beast devouring silver. Second, new energy vehicles, NEVs. A traditional internal combustion engine car only needs about 15 to 20 grams of silver, but a smart NEV, packed with complex electronic components, radar, sensors, and high-end circuit boards, consumes as much as 50 to 60 grams of silver. As the global penetration of NEVs continues to climb, silver demand in this sector is skyrocketing. Third, high-end electronics and AI. 5G base stations, semiconductors, precision medical devices, and even the data centers driving AI computing. None of these can can function without silver, the world's #1 conductor of electricity. Now let's look at the supply side. The supply situation for silver can be described in 4 words: a dead end. Silver deposits on Earth have been mined for thousands of years. The ore grades are getting lower, and mining is becoming more difficult. What's worse is that there are very few pure silver mines. About 70% of silver is produced as a byproduct of mining base metals like copper, zinc, and lead. What does this mean? It means even if silver prices skyrocket, miners cannot easily increase production by simply opening silver mines, because they won't mine massive amounts of lead and zinc, metals the market doesn't currently need, just to get a little bit of byproduct silver. Furthermore, due to the prolonged low silver prices over the past decade, global mining giants have severely underinvested in silver exploration and new mine construction. It takes at least 5 to 10 years for a new mine to go from exploration to production. This historical debt means that even though prices are up now, new capacity simply cannot keep up. Right on January 1st, 2026, China, a major global silver refiner and exporter, officially implemented export restriction policies on certain types of refined silver. The implementation of this policy directly choked a key link in the global supply chain, making the already strained overseas physical silver market even worse. According to authoritative forecasts, in 2026 alone, the global silver market will face a massive supply deficit of as much as 67 million ounces. And please note, this isn't the first year of shortage. This is the 6th or 7th consecutive year of a severe structural supply-demand deficit in the silver market. Years of supply deficits are aggressively draining global surface silver inventories, such as the LBMA and COMEX delivery vaults. The day the surface inventory is drained will be the day silver prices spiral out of control to a point where even Wall Street won't be able to suppress them. This rock-solid underlying supply-demand logic dictates that the center of gravity for silver prices must move higher. Any short-term price correction cannot change the objective fact that physical silver is rapidly disappearing. Having discussed supply and demand, let's talk about the twin sister relationship between silver and gold. Throughout thousands of years of human monetary history, silver and gold have always been the two sisters of the market, moving in tandem. The core metric to measure their relationship is the gold to silver ratio, GSR, which is the price of 1 ounce of gold divided by the price of 1 ounce of silver. It represents how many ounces of silver you need to buy 1 ounce of gold. Historically, the ratio of silver to gold in the Earth's crust is about 15.1, and for most of ancient history, the GSR was fixed at around 15.1. In modern times, because silver is widely used in industry and heavily consumed, while gold is rarely consumed and only accumulates, silver should theoretically be scarcer than gold. However, under the long-term suppression of Wall Street's financial derivatives, the GSR is often distorted to extreme highs. In 2026 today, with global inflation rampant and geopolitical crises frequent, out of extreme fear of the collapse of fiat currencies, global central banks and oligarchs are frantically hoarding gold. This has driven gold prices to an unimaginable level of over $5,000 per ounce. What about silver? Since gold has risen so much, silver, as the little sister, should naturally welcome an earth-shattering catch-up rally. Based on the current gold price of 5,023 Oz and the silver price of 81.34 Oz, the current GSR is around 61. For retail investors unfamiliar with history, the number 61 might not mean much, but during the peaks of precious metal bull markets like 1980 and 2011, the GSR has historically contracted to 30.1 or even 15.1. This means that in the second half of a silver bull market, silver's gains often far exceed those of gold, showing extremely violent elasticity. If the GSR returns from the current 61 to the historical bull market average of say 30.1, and assuming gold stays at $5,000, what should the fair price of silver be? $166 per ounce. What if gold continues to push towards $6,000? Silver could even break through $200 per ounce. Therefore, from the perspective of pure asset price parity and historical patterns, silver hitting $121 in January was not a bubble at all. It was just silver attempting to repair the long distorted GSR, a normal release of years of pent-up momentum. Silver should have naturally continued its catch-up rally to break $150 or higher. But why was silver smashed down just as it touched $121 in January? Why did this perfectly normal market reality suffer such a brutal sniper attack? This leads to the core and darkest theme of today's video: Wall Street's conflict of interest and the grand conspiracy. Silver rising in line with supply, demand, and the GSR catch-up is perfectly logical, but this reality came into severe conflict with Wall Street's own interests. As we all know, the global pricing power of silver is not in the hands of the miners working hard in the pits, nor in the hands of industrial giants who need the physical metal. It is held by Western financial oligarchs represented by the New York Mercantile Exchange, COMEX, and the London Bullion Market Association, LBMA. They manipulate the price of physical silver by issuing astronomical amounts of paper silver, futures, options, and OTC derivatives. According to long-term exposure by insiders and independent analysts, the amount of paper silver circulating in this market is tens or even hundreds of times the amount of actual physical silver. In other words, the exchanges simply do not have enough physical silver to back these contracts. It is purely a Ponzi scheme built on confidence and leverage. In this scheme, large Wall Street commercial banks, like certain top-tier investment banks often fined for market manipulation, have long played the role of super shorts. They use their capital advantage to build massive short positions in the futures market to suppress silver prices and maintain the illusion of prosperity in the US dollar system, because a surge in gold and silver prices is the most direct indicator of a bankrupt dollar credit. As long as the silver price stays at the bottom, their short positions are safe as a mountain, and they can even earn rollover profits. However, the epic rally of silver toward $121 in January 2026 completely shattered Wall Street's dream and pushed them to the edge of a cliff. Imagine this: when the silver price was charging like a wild horse, those massive short positions held by Wall Street institutions instantly faced terrifying floating losses of tens or even hundreds of billions of dollars. More importantly, as the price surged, more and more large players and institutions weren't just asking for cash settlements, they actually started demanding physical delivery. Wall Street completely panicked. As we said earlier, the exchanges don't have that much physical silver. Once a bank run occurs, Wall Street shorts will face the default abyss, which would be the biggest scandal and disaster in financial history. To save themselves, Wall Street shorts had to quickly hedge their risks and close their short positions. But how? Closing a short means buying to cover. If they went directly to the secondary market to buy physical silver to hedge, given the extreme supply-demand tightness, their astronomical buying volume would instantly push silver prices to another higher universe level, maybe $200, maybe $300. If they did that, they wouldn't just fail to buy enough silver, they would drive the price up and make their remaining shorts lose even more. That would be like setting themselves on fire and digging their own graves. So buying physical silver to hedge was a dead end they couldn't take. Then, what was the only way out for Wall Street? By contrast, using every means necessary to smash the silver price down was their best and only method of self-salvage. This is exactly where the Wall Street conspiracy lies. Only by forcibly crashing the price, blowing up the long-positioned retail investors, and creating extreme market panic to trigger a retail selling wave could they pick up blood-stained chips at low prices to close or roll over their massive short positions. How did they do it? Now it's time to reveal Wall Street's dirty tactics. Step 1. The exchange changes the rules. As mentioned before, in February, the exchange suddenly and without warning hiked silver futures margin requirements. This meant retail traders who could previously hold longs with a small amount of money had to immediately top up with huge amounts of cash or be forcibly liquidated. Most retail traders couldn't produce that much money, so long positions instantly turned into a landslide of sell orders and the price crashed. Step 2. High-frequency trading and spoofing. Wall Street's quantitative robots dumped millions of ounces of sell orders into the market in an instant, creating a crushing pressure. These sell orders weren't meant to be filled. They were meant to create extreme panic on the tape. Once the price collapsed and triggered retail stop-loss orders, they instantly cancelled the unfilled sell orders. Step 3. Media coordination. When silver dropped to $80 or $70, Wall Street-controlled mainstream financial media began flooding the airwaves with negative fake news like the silver bubble has burst, or industrial demand fails to meet expectations, further destroying the retail investors' psychological defenses. So, my friends, please see clearly the bloody truth behind this. Smashing silver down to get rid of their own short positions is the core driver behind Wall Street's ruthless suppression. This is not a natural market correction. It is a cold-blooded financial massacre. It is the ruling elite lifting the butcher's knife against retail investors to save their own lives. Now that we understand Wall Street's conspiracy, let's dive deeper into the internal logic of the current market from the perspective of retail psychology. Plus, the fact that silver rose too fast in January inevitably led to a fatal problem. Too much retail momentum chasing money entered the fray. Think back to the scene when silver surged to $121 in January. When silver broke $80 or $90, most retail investors were still watching. When it broke $100, they started to feel tempted. When silver violently rallied to $110 and $120 in a single week, human greed was completely ignited. People on the streets and even grandmas were talking about buying silver. Countless retail investors, who usually don't look at macroeconomics or supply-demand logic, took their life savings and jumped into the market with maximum leverage. This is the typical retail investor. They don't understand the core logic of the rise, like the industrial deficit or GSR repair we discussed. They just buy because it's going up. They jump in blindly just because the K line is red and the news says it will keep rising. This kind of capital, which lacks conviction and knowledge and only seeks short-term profits, is what we call momentum chasers or floating chips. If a train is packed with this kind of passengers who are ready to jump off at any moment or trample each other at the slightest sign of trouble, this train will never reach its destination. For the institutional whales, even those who are bullish, when the train is crowded with too many retail momentum chasers, they will never be kind enough to keep pushing the price up and let these retail investors make easy money. For the market to continue its breakout, it must consolidate and wash out these floating chips. This is another objective and unavoidable reason for the pullback. When Wall Street smashed the price from $121 to $65. What do you think those retail investors who chased at $110s and $120 were thinking? On day one of the drop, they said it was a technical correction. On day two of the crash, they began to panic. On day three, as it kept falling and broke their maintenance margins, they were forcibly liquidated, crying as they were carried out of the market. And now, silver is oscillating and moving sideways near $81. This kind of price action is the most agonizing. It doesn't crash, but it doesn't rally either. It just fluctuates by a few cents every day. The purpose of this movement is to use time to grind away the remaining retail investors' patience. Those surviving retail chasers during weeks of consolidation will start to think silver has turned weak and is hopeless, eventually surrendering their precious chips in extreme despair and boredom. A washout isn't about washing the price, it's about washing the human heart. Only when the vast majority of retail investors are completely hopeless and swear never to touch silver again will the chips be concentrated back into the hands of institutional players. Only when the car becomes light will silver start its next true, moonbound main wave. Therefore, the current pullback is the result of a double resonance. Wall Street's conspiracy to cover shorts and the institution's tactical move to wash the market. It is not a deterioration of fundamentals, it is a necessary path in the capital markets. Having said all this, I believe you now have a crystal clear understanding of how the silver market operates. Since we have seen through Wall Street's conspiracy and understood the essence of the washout, what should we as ordinary investors do? The answer is simple, yet very few can do it. Right now is the low point of the correction, and we must completely abandon the retail mindset and strictly execute buy low, sell high. What is retail mindset? It is thinking, because it fell in the past, it will keep falling in the future. Because it isn't rising now, I won't buy now. Then, one day when silver breaks $100 or even $120 again, and the news is everywhere, you suddenly feel this time is really different, and then sell everything to chase in. That is typical buying high and selling low. And that is the fundamental reason why 90% of retail investors always lose money in this market. Do not wait until it's above $100 to chase in. When the price is far from the bottom and everyone knows it's a good thing, the risk to reward ratio is already extremely unfavorable. Entering then means you are likely becoming the bag holder for Wall Street. What is institutional main force mindset? It is buy when no one cares, sell when the crowd is roaring. Be fearful when others are greedy, and be greedy when others are fearful. Right now, at this very moment in mid-March 2026, the silver price is hovering around $81. The market is quiet. No one is praising silver. The retail investors trapped earlier are licking their wounds, and the weak hands are cutting their losses. Look, isn't this exactly the place where no one cares? From a macro perspective, the 67 million ounce annual supply deficit hangs over the market like the sword of Damocles. Geopolitical conflicts in the Middle East are ongoing. The Federal Reserve, due to stubborn inflation and economic risks, will eventually be forced to keep releasing liquidity. Gold, standing firm at $5,000, has set a solid valuation ceiling for silver. The fundamentals have not only avoided deterioration but are becoming harder over time. Technically, after this storm-like washout, silver has built a rock-solid support platform between $70 and $80. Many technical indicators, like the RSI, have retreated from the severe overbought levels of January to currently neutral or even oversold zones. The current price level is the perfect low point for silver to accumulate strength and solidify its foundation. So, my friends, do not let short-term clouds blind your eyes. The current pullback is exactly the last chance for us to get on board, gifted to us by God or by Wall Street's greed. To help you more deeply understand the logic I've shared today, I think it's necessary to take you back through the long river of history to look at several heart-pounding dramas that have played out in the silver market over the past decades. You will find that there is nothing new under the sun. Everything happening today in 2026 has played out word for word countless times in history. Story 1. The Hunt Brothers Short Squeeze of 1980. Anyone familiar with the history of silver must know the famous American Hunt brothers. In the late 1970s, as the United States was mired in stagflation, inflation soared. Spotting silver's inflation hedging properties and physical scarcity, the Hunt brothers began aggressively acquiring physical silver and futures contracts. By January 1980, they had driven the price of silver from just a few dollars all the way up to $50 per ounce. That was $50 in 1980. At that time, Wall Street financial giants also held massive short positions and faced the brink of bankruptcy. How did they deal with the Hunt brothers? You guessed it, they changed the rules. The New York Commodity Exchange COMEX directly issued the infamous Rule 7, which not only sharply raised margin requirements but, more importantly, announced that only closing positions were allowed for silver futures. No new long positions could be opened. In other words, you could only sell, not buy. As soon as this rogue rule took effect, silver prices crashed, plummeting by more than half within days. The Hunt brothers were instantly hit with massive margin calls and eventually declared bankruptcy. Wall Street shorts not only escaped successfully but also made a huge profit. See, isn't this exactly the same tactic the CME used in February 2026 by raising margins to smash prices? When Wall Street finds itself losing, it just flips the table and pulls the plug. Story 2. The Great Silver Bull Market and Crash of 2011. Fast forward to 2011. Following the Federal Reserve's launch of large-scale quantitative easing, QE, after the 2008 subprime mortgage crisis, massive capital flowed into inflation-resistant assets. Silver once again enjoyed its moment in the spotlight, approaching its previous all-time high and reaching 49.8 per ounce. Retail investors poured in frantically at that time, even giving rise to the spectacle of Chinese aunties snapping up silver jewelry and bars in a buying frenzy. What happened next? Just as silver was about to break the all-time high of $50 and shorts were on the verge of total ruin, the Chicago Mercantile Exchange, CME, sharply raised silver futures margin requirements 3 times in just a few days, with a total increase of an astonishing 84%. This once again became the final straw that broke silver. Silver then entered a long and brutal bear market, trapping countless retail investors at the highs, leaving them in utter despair. Story 3. Wall Street silver retail short squeeze on Wall Street in 2021. In early 2021, inspired by retail investors defeating Wall Street institutions in GameStop, GME, retail investors on Reddit founded the Wall Street Silver Community, vowing to trigger a run on COMEX by purchasing physical silver and the silver ETF, PSLV, to break Wall Street's manipulation of paper silver. Silver prices surged sharply in a short period, but in the end, Wall Street investment banks once again used their massive paper capital pools for high-frequency selling, forcibly suppressing prices. What conclusions can we draw from reviewing these 3 historical events? First, every major surge in silver is underpinned by an extremely solid macro foundation: inflation, excessive currency issuance. Second, every time silver rises to a critical level that seriously threatens the interests of Wall Street shorts, they will resort to any means to use their rule-making advantages, raising margins, malicious short selling, to smash prices and save themselves. Third, every sell-off hurts the retail investors the most, those who are blinded by greed at the highs, chase the rally, and overuse leverage. History repeats itself strikingly. The market rally from January to March 2026 is simply the ultimate hybrid of 1980, 2011, and 2021. Wall Street's tactics have not changed at all because they always work on retail investors. Now that we have seen through the script, why should we cooperate with them to act out a tragedy? When Wall Street raises its butcher's knife to smash prices, retail investors sell in fear, which is exactly what Wall Street wants most. Their conspiracy succeeds. They seize your blood-stained chips, close their short positions, and then one day in the future, they will reverse course and go long, pushing silver to heights you cannot even imagine. At that point, they will sell to you at the highs once again. The only way to break this curse is to do the opposite. At the low levels where they smash prices and create panic, such as around $81 now, quietly build positions in batches, buy and hold, and stand firm on your chips. Many retail investors fail to hold their positions and get shaken out during washouts because they lack a holistic vision of the macroeconomy and have no confidence. To help you truly achieve a full granary, a steady heart, I will next deeply analyze the current macro landscape of 2026 with detailed data and facts, explaining why silver's upward momentum is not exhausted but even stronger. First, the US dollar credit crisis and fiat currency devaluation. Look at the United States today. The federal government's debt has long reached astronomical levels, and annual interest payments alone are suffocating its fiscal position. This is an irreversible debt spiral. To fill this black hole, the Federal Reserve has only one long-term card: printing money, meaning endless currency devaluation. When fiat currencies lose credibility, capital inevitably flows to hard assets. Gold breaking through $5,000 is a resounding vote of no confidence in the US dollar from global capital. As the poor man's gold, silver has a relatively small total market capitalization. Once targeted by safe haven and inflation hedging capital, its price elasticity will explode exponentially. As long as the root cause of excessive fiat currency issuance remains, the bull market in precious metals will never end. Second, the continued escalation of geopolitics. It is March 2026. Look at the news. The war in the Middle East is still raging, and the Iranian situation in particular has triggered severe turmoil in the international energy market. Oil prices remain high, meaning global inflation will stay under intense pressure. In this turbulent world, gold and silver are the safest havens. Wall Street can manipulate prices with paper contracts in the short term, but it cannot control missile launches, great power competition, or the desperate global demand for safe assets. Third, the explosive surge in physical demand. As I mentioned earlier, China introduced export restrictions on refined silver in early 2026. The impact of this policy will gradually emerge in the coming months. China is the absolute dominant player in the global solar photovoltaic industry, accounting for over 80% of global production capacity. This means China not only produces silver itself, but also needs to import large quantities or retain silver originally destined for export to meet its huge domestic photovoltaic manufacturing demand. This will leave high-tech and military enterprises in Western countries such as the US and Europe facing the awkward situation of having money but being unable to buy physical silver. Just think, when Apple needs silver to make iPhones, Tesla needs silver to make cars, Lockheed Martin needs silver to make missiles, and there is simply not enough physical silver on the market. What will they do? They will have to snap up frantically in the spot market regardless of cost. Can this real, rigid demand based on industrial survival be suppressed by a few Wall Street short futures contracts? Absolutely not. Paper cannot cover fire. Once the spot premium reaches a critical point, the paper-silver pricing mechanism will completely collapse. Finally, let's look at the real forecasts of major institutions for silver's future. Although Wall Street publicly suppresses silver, secretly, its own analysts have to acknowledge silver's intrinsic value. For example, JP Morgan predicted in a recent report that the average silver price for 2026 will be above $81, and even more aggressive investment banks have set target prices as high as $130, $150, or even over $300. Why? Because even they know supply-demand gaps can never be faked. So the current market logic is crystal clear. Fundamentals support silver soaring to unprecedented heights, but Wall Street, trapped by its own position crisis, is using every means to hold it down at the current correction low, trying to wash out retail investors through long, tedious consolidation. This is an extremely distorted market condition, and this distortion has created a historic wealth-making opportunity for us smart investors. No matter how eloquent the analysis, everything ultimately comes down to execution. After seeing through Wall Street's conspiracy, how can we protect ourselves and maximize profits in the market ahead? I have summarized the following hard-earned lessons and practical rules which you must keep in mind. Rule 1. Never, under any circumstances, use high leverage to gamble on silver's short-term fluctuations. If you understood the historical stories I told earlier, you will realize that the silver market is one of the most manipulated and volatile markets on Wall Street, known as the widowmaker. Sharp rises and falls are common here, and a 10% daily drop is not unusual. If you use high leverage, such as futures or high leverage CFDs, even if you are right about the direction, Wall Street only needs a long lower shadow of dozens of dollars before launching the main rally to liquidate you instantly, killing you in the darkest hour before dawn. Therefore, the top priority of investing in silver is to survive. Use capital you can afford to lose, trade spot or low leverage products, or practice dollar cost averaging. Do not try to make quick money on silver. Treat it as a long war. Rule 2. Buy physical silver or fully physical backed trust ETFs. Since Wall Street is running a paper fraud, the best weapon to defeat them is to drain their physical supply. For ordinary people, if possible, buy physical silver bars and coins, holding wealth firmly in your own hands. This not only eliminates counterparty default risk, but also serves as life-saving hard currency in extreme crises. If you find storing physical silver troublesome, in the stock market you can choose ETFs that promise 100% physical backing, such as the Sprott Physical Silver Trust, PSLV. Avoid derivative funds based on futures contracts as much as possible, as they may be forcibly liquidated or have rules changed at critical moments. Rule 3. Practice dollar cost averaging. DCA, using emotional insensitivity to counter Wall Street's psychological washout warfare. We now know for certain that around $80 is a correction low, a golden pit, but none of us can accurately predict how long Wall Street's sideways torture will last, a week, a month, or 3 months. If you go all in today in one go and it does not rise for the next month, falling just a few cents each day, your mentality will definitely collapse, and you will most likely still fall before dawn. The correct approach is to formulate a phased buying plan, systematic investment plan, SIPs. For example, divide the capital you plan to invest in silver into 10 or 20 parts. Buy one part now at $81. If it falls to $75, buy 2 more parts. If it is smashed to the super strong support level of $70 in an extreme scenario, buy more boldly. Use dollar cost averaging to lower your average holding price, maintaining the emotional insensitivity of, I am happy even if it falls because I can buy cheaper chips. As long as you hold unleveraged low-cost chips, you can sit firmly on the fishing boat no matter how much Wall Street stirs up trouble. Rule 4. Reverse thinking. Be fearful when others are greedy, and greedy when others are fearful. Let us review this iron law of investing once again. Recall the madness of people around you when silver hit $121 in January. Now look at the desolation as silver has fallen to $80, with forums filled with complaints and no one mentioning silver anymore. Investing is a game of human nature. To make money, you must overcome the human instinct to follow the crowd and do the exact opposite of the masses. In this market, truth is always in the hands of the few. Right now, retail investors are cutting their losses, and Wall Street is secretly accumulating chips. What you should do is stand with Wall Street and seize the bloodstained chips discarded by retail investors. Do not follow suit when it rises above $100 and the media hype returns. At that point, you will become the next batch of leaks to be harvested. Finally, let us summarize today's core logic in the most concise terms, from the depths of the soul. The foundation of silver's great bull market is extremely solid. The world has entered an energy transition era. Industrial demand from photovoltaics, electric vehicles, and other sectors has exploded, while mine supply is severely insufficient. Coupled with China's export restrictions, consecutive years of physical silver supply shortages have become an irreversible historical tide. Prices are extremely distorted, and a catch-up rally is inevitable. Gold has soared to towering heights, breaking through the $5,000 mark. As gold shadow metal, silver is currently severely undervalued, and the demand for a repair of the gold-silver ratio is extremely strong. It is not a question of whether silver will catch up, but when and in what violent manner it will do so. Wall Street's shocking conspiracy and desperate act. Wall Street institutions are trapped in massive short positions in the paper silver market. They neither dare nor can buy physical silver to close their positions. When silver surged to $121 in January, pushed them to the brink of default, they could only smash prices back into the abyss by changing rules, raising margins, and malicious selling, thereby eliminating the risks of their short positions. The fatal flaw of retail thinking and the necessity of washing out. January's surge attracted a huge number of blindly high-chasing retail followers. This overloaded train must undergo a brutal crash and desperate sideways movement to completely wash out these wavering floating chips. The only correct solution to the current situation, the price range around $80, is the golden low smashed out by Wall Street, an excellent strategic position building period. We must completely abandon the retail thinking of chasing gains and selling losses. Never chase highs above $100 in the future, but instead decisively buy low at the current time of neglect, hold patiently, and use time to exchange for huge future returns of several or even 10 times. Friends, investing is a path of spiritual cultivation. More often than not, it is not just your IQ and logical analysis abilities that matter, but your patience, discipline, and courage to act against human nature. Wall Street indeed possesses powerful capital strength, public opinion control, and rule-making power, making it almost unbeatable in short-term local battles. However, in the face of the iron laws of the physical world, the reality of supply-demand gaps, and the rolling wheel of historical cycles, no financial oligarch can forever block the return of value. They could not stop gold from breaking through 2,000, 3,000, and now 5,000, and they will never stop silver from launching a historic assault toward $150 or even $300 in the future. All they can do is delay time, harvesting leaks with insufficient cognition through fear and greed in the process. If you think today's in-depth video has subversively improved your understanding, and if you agree with the deep logic behind silver that I have analyzed, please do me a huge favor. Tap your finger to give this video a big thumbs up and click the follow button to subscribe to our channel. At the same time, I strongly recommend that you share this video with your relatives and friends and forward it to every investment communication group you are in, because we want more confused retail investors to wake up. We want everyone to see through Wall Street's conspiracy, and we must not let ordinary people's hard-earned money become the capital for those financial oligarchs' revelry. If you have any questions about the current trend of silver, or if you are currently holding silver in a trapped or profitable position, please leave a comment below the video to share your positions and mindset. I will also interact with you deeply in the comments section. Remember, only by sticking together can we go further in Wall Street's encirclement.